IRS Form 1099-K, Payment Card and Third-Party Network Transactions, is an IRS information return used to report certain payment transactions to improve voluntary tax compliance. 1099-Ks are most often reported by third-party settlement organizations, or TPSOs. These include payment card providers and third-party network providers. TPSOs are required to mail Form 1099-Ks to recipients by January 31st for the prior calendar year amounts. Tax preparers need to understand what generates a Form 1099-K so they can ensure their clients are reporting their income accurately on their tax returns. Separate reporting of Form 1099-K is not normally required by the IRS. Within Drake Tax, gross receipts received via payment card, which is credit cards and debit cards, and third-party network payments can be entered on the following screens as an undifferentiated part of gross receipts. Screen C, Schedule C, Screen E, Schedule E, Screen F, Schedule F, Screen INC in the 1120, 1120S, and 1065 returns, and Screen 99K, but that is for state use only. Data entered on the 99K screen located on the States tabs is used to produce a copy of Form 1099-K for certain states that require the source document for e-file purposes. State tax withheld entered in Box 8 is the only amount that flows to a state form. The 99K screen is only for use by states that require the source documents. No data entered flows to any federal form. Sometimes a taxpayer may receive a 1099-K for personal items sold at a loss. In these cases, there is no loss allowed on the return. IRS guidelines indicate the best method to report these transactions. Enter the 1099-K amount on Screen 3, Line 8Z, using the drop-down menu to choose Form 1099-K personal items sold at a loss. Drake will automatically fill Screen 4, Line 24Z, with the corresponding amount to wash the transaction and net it to zero. For personal items sold at a gain, the gain is a capital gain taxable on the return. Report as you would for other sales of capital assets on Screen D or Screen 8949. In addition, taxpayers should adjust the gain or loss on the sale of their personal property by the amount of expenses and fees paid to facilitate the sale. If the taxpayer realizes a gain on the sale of their property, report the selling expenses as a downward adjustment to the gain that they report on Form 8949 or Schedule D. In Drake Tax, selling expenses can be added to the amount in the cost field 1E on the 8949 or Schedule D screens. For a mix of personal items, some sold at a gain and others with a loss, each transaction must be reported separately. Gains cannot be offset by losses. Follow the rules for items sold at a gain or at a loss as appropriate. So if a taxpayer receives an incorrect 1099-K, they should contact the 1099-K issuer to ask for a corrected 1099-K. If the taxpayer cannot get a corrected 1099-K, report using the same process as personal assets sold at a loss. The amounts on both Schedule 1, Part 1, Line 8Z, and Part 2, Line 24Z, will be the same for 1099-Ks that should never have been received for personal income. For more information, visit drakesoftware.com.